Hey, this is Jason with Two Sides of Phi. You've asked for more stories of non-traditional Phi journeys, and today I'm talking with David Sun. He's in his mid-30s, lives in the greater Washington, D.C. area, and was trained as an electrical engineer. But he caught the investing bug early on, and before he knew it, started a new undertaking as a hedge fund manager. He's recently achieved financial independence and also hosts his own podcast, The Trade Busters. Join me for our conversation and learn all about how David did it. David, welcome to Two Sides of Phi. It's great to have you.
Jason, thank you for having me on and the opportunity. I'm excited to be here.
Excellent. Well, one of the things that our audience asks for, probably more than anything, I know Eric would agree, is this idea of non-traditional stories of achieving financial independence. Because, one of the things that I think a little unfairly the FIRE community gets the reputation for is it's only Silicon Valley software engineers that can set out on a trajectory or find themselves on a trajectory, which is often the case, as we'll discuss, towards financial independence because of their extremely high salaries, and they sort of started with a huge leg up. And so the opportunity to talk with you as somebody who has taken a different path and is on a very interesting journey, I think, is one that we definitely like to investigate here. So can you tell me, David, a little about your background? What did you choose to study, and how did that lead you to where you are today from a trading perspective?
Yeah, no, certainly. So my background's actually in electrical engineering, and I was doing a master's degree at Princeton in New Jersey. This was around 2008, 2009. So a couple of things. It was during school, but if I say 2008, 2009, something probably rings a bell. It's the
Yeah, it sure
GFC.
does.
So even if you weren't into the markets per se, the market was going to be on your mind, right? So I kind of chose that time. I got interested. I was like, oh, I bought some books. Maybe I'm going to try stock picking. I was watching Jim Cramer on Mad Money, just really novice stuff. Now, I had a buddy in grad school who traded options, and he was like, oh, if you're getting into finance, like try options. So that's kind of interesting because I really didn't even do the stock picking thing very long. I went straight into options.
Wow.
And then not only that, he taught me to sell options. So I bypassed the whole YOLO calls, FOMO, buying lotto ticket. I went straight to premium selling, put selling,
Oof.
right? Now, for better or for worse, because, kind of when I started, it was around the bottom. So for a couple of years, year and a half, you could sell puts on anything, right?
Yes.
So rather than buying the stocks that Jim Cramer mentions, sell puts on them, And then so everything was going well. I was like literally counting how many percent. Oh, if I sell this, I'll make X percent a month. I'll make X percent a year. I'll have $8 million in 30 years, something like that. And, obviously things don't work out like that. So after a couple of years, it went well. But after there was eventually a turnaround, probably gave some back. I got lucky because I was around that time buying my first house. So I took some money out. So dumb luck, took the profits, bought a house, and actually kind of pulled back from trading for a while just because I realized it wasn't all that I thought it was, right? But I was working and I had a colleague who he was interested. He knew I talked about options on and off, and he wanted to get into it to learn so we can kind of manage it, be self-directed investors. So he kind of got me into it and got the bug again because he found Tasty Trade, and this was the online options community and a lot of educational content. So like I was kind of re-upping my learning curve. Now found them a couple years, found my footing, was kind of honing my craft, and I got the harebrained idea to launch a hedge fund. Now don't ask me how I got the idea, okay?
Wow.
Because I just thought, hey, if I'm doing this thing, I'm trading, and if I could raise some money, charge some fees, now I'm trading other people's money. I'm not physically doing anything different. It's just more contracts, right? But I'm getting paid to do the same thing I've been doing. It seemed very appealing. Now, again, super naive, just like everything. It was super naive to just dive right into it, but seeded it with a little bit of personal capital. Took couple years before I even got enough actual investor money to like be profitable on the fees. But then eventually, just like a typical new business trajectory, third year, things take off. I actually ended up launching. So this was 2018 when I launched my first options-based hedge fund. Then 2021, I launched a second one. And so now it's what, 2024. It's been 5.5 years or something like that. And that's kind of my path. So again, as you trading itself is a very scalable type of business model.
Right.
If you can gather assets, raise funds, and trade other people's money, and that's just supercharges it, right? So that's
Right.
kind of my path to, I don't know if you want to call it financial independence. It's it can be a lucrative business, right? You have to perform and be consistent and all that. So
Yeah.
I don't want to say it's easy by any means, but that was kind of like my path from a just a
Right.
off the street retail trader to like a homegrown hedge fund manager, so to speak.
Wow. Okay. So for both for me and for the audience, let me first say I think that sets the stage well, but I'd like to rewind and summarize a little bit. So it sounds like in the course of about 10 years from the time you're a graduate student in engineering to launching a hedge fund is about 10 years.
Yes, that's right.
And then in the last year or so, you've actually achieved financial independence via this path. That's quite a trajectory. But how was it that you were exposed to trading in the first place? I mean, do your parents, your family work in finance, or is this really just a friend? Or how did you start exploring the idea of trading?
No, nothing. It was just like I said, market was going crazy. I thought I would dip my toes in, and that friend was like, "Hey, try options," and that was literally the started the ball rolling. And then the path. There's a steep learning curve, right? So like you said, 10 years until I quote unquote launched my first fund from just day one of selling a put, right? But no, it was just dumb luck that I knew a guy, right, that
Yeah.
knew options. But yeah, no, like you mentioned earlier, like kind of a very non-traditional, like the idea of fire and trying to achieve that financial independence. It's that's kind of a non-traditional idea to begin with, but my
It is.
pathway was even more off the beaten path, right? So yeah.
Yeah, it absolutely is. One of the things I've noticed in the fire community, well, there's a couple things I noticed in the fire community. One, a lot of engineers and a lot of engineers and scientists who really enjoy the math and then naturally get drawn to trading, but also this idea of entrepreneurial spirit. So, are you somebody who growing up was always looking to start little businesses, or did you, given your age, did you take advantage of early days internet kind of, and do anything that made money, or is that something that just kind of evolved as you got interested in trading?
You know what? I really wasn't any of those things. I think it's just something where I pick up an interest, and if I really enjoy doing it and I'm passionate, I will pursue it and try to kind of master the craft. And if it's something that you can monetize, that's a benefit, right? So I don't necessarily, like I said, I never even dreamed that I'd be managing two hedge funds, right? 10 years later, for instance. It was just something. And what you said rings true about options in particular and engineers, right? Something about options trading kind of resonates with the brain of an engineer. So
Yes.
it was just something that I really thought was interesting. It's like a puzzle or a problem you want to solve. And I think again, how I got the idea of like, hey, if I scale this up, raise money, charge fees, etc. Like somehow that just sparked along the way once I kind of found my footing. So it was just like this very organic
Yeah.
kind of just stumbling into that path, if you will.
And I love that idea. I mean, my two sides of my show partner Eric had an entrepreneurial mindset pretty early on, but he also wasn't. He didn't set out to start a business to become financially independent. He was a traditionally employed architect. The firm he was with was going through some challenging times. They were reducing compensation, and he ended up sort of out of necessity going out on his own. And he evolved this entrepreneurial spirit over time, and it's led him to financial independence by 50. So we didn't get there as fast as you did, but we took our independent paths to get there. If I'm not mistaken, you are still working in engineering. Is that correct? This is something you're doing in addition to having a day job like most of our audience here. Is that right?
Yeah, no, I am still employed. I don't normally go into details of the job itself, but I
Of
think
course.
what helps to give people context, it's a telework job, so it's flexible. But not only that, again, speaking to the scalability of of fund model business, we're not day trading, right? So we run kind of we're like 95% automated. So during the regular trading day, which is kind of work hours, we just have our laptop, we're running our algo, whatever it is, and we call ourselves glorified babysitters, right? If we don't get paged, we have systems that tell us if XYZ might be going wrong. On a good day, no news is good news, right? So I
Right.
can focus on my work. And the interesting thing is like what I consider the actual work for the fund is the research, right? Back testing or dealing with investor paperwork, administrative stuff. But all of that can be done asynchronously. It doesn't have to be during market hours. So again, my path is not only kind of unique, but like kind of incidentally works well with the flexible work schedule. So, unfortunately, I don't think everyone can find some kind of gig or side hustle that's so kind of synergistic with your actual work schedule. But again, kind of dumb luck that that worked out that way.
Let's talk about the Trade Busters community that you've started. When did that come about, the podcast, and really what were your goals and what are your goals for Trade Busters?
Yeah, interesting. That's kind of tangential. It's separate, but also kind of related to my, fund, if you will, just trading in general. Um, I've always associated myself with the retail community because I started with Tasty Trade, for instance. We're in Facebook groups online, and I got a lot of learnings. In the beginning, everything's a learning, right? But at some point, large groups are just too much noise. You kind of can't really get any as much value as when you're beginning.
Yeah.
So I started the Discord group just as a way to pull some people that I thought, were like-minded or traded in a similar way, or kind of we all had the same philosophy and approach in risk management, options trading. And the podcast was part of that. Was I was posting, for instance, like, people always just post random, like random winnings or, on the
Sure.
group, but it's very mismatched. There's not really any rhyme or reason. So I started trying to post more regularly and systematically. And I also wrote some essays, which on various topics, which I thought were valuable to kind of new traders. And so I found that writing for me comes hard, talking comes easy. So I can sit down and just record a topic, 20 minutes,
Yes.
30 minutes. And so it just became a podcast. The podcast was just an audio form of these essays I was writing. And then so when the podcast came about, I started hosting the podcast on this Google Sheets page I have, I'm sure we'll mention later. But then not only that, it was the repository of the essays I've written. I make all these spreadsheets on different strategies and
You
different
do.
mechanics and notes. A lot of content, like you mentioned, and it's just like this repository of stuff that I felt would be valuable. There's like spreadsheets on tracking your account balances, strategies on doing probabilities, and all kinds of things. And those were all happening. I think I started a podcast like summer of like 2022 or something, and
Okay.
it's like 100+ episodes. I don't know how I got so much out there, but that was all kind of my own personal brain dump, if you will, but hopefully also to help kind of the future, up and coming traders. At the same time, the community of Discord was just something where, like, again, gathering ideas, having a space. I mean, you remember that community now, right? So I
Yeah.
think you found it, a few months back. So you know how it is. It's very lively, but the people in there's like a exam process to get in. So
There is.
it's a little bit vetted, but that helps kind of the signal to noise ratio. So and so all those things are going on at the same time as I'm doing the fun, and all those things are just like, yeah, that's kind of my life right now, I guess, in the last couple years.
Yeah. Yeah, yes, and I have to tell you, I was a little anxious that I might not pass the test on the first go, and I was very pleased that I did. But the way that I encountered you first was actually probably 2 years ago, and it was because I was doing some background work for one of our earlier conversations on Two Sides of Five with Karsten Jeske, big earn from the Early Retirement Now blog. I know you know who he is, but for anyone in our audience who isn't familiar, we've talked to Earn, I think, 3 times at this point.
Wow.
Either I've talked to him once, Eric and I talked to him once, and then we had a great conversation with both him and Fritz Gilbert from Retirement Manifesto about drawdown strategies and his feelings about the bucket strategy and how it's not appropriate or it's just window dressing. But I won't reopen those wounds now, but really great conversations. Anyhow, one of them, I was just looking for older content on how Earn's option trading strategy had evolved over time. And I had seen your name come up in the comments on his blog because I read all the comments on his blog. There's so much meat there, honestly, for people who are interested. And I found an old conversation with you and Earn talking about his then primarily 0 and 1 DTE put selling strategy. And I believe you influenced him on his own strategy. I've seen him refer to that about employing stops or not. Why don't you tell me about how you came across Earn and how that impacted you?
Yeah, and just so your audience knows, I think Earn was the main avenue through which I kind of discovered the fire community. So all my thoughts on it are really shaped by his blog and content.
Yeah.
Um, and it was during the course of, just general research for the fund strategies, ideation, we were exploring trading options of different expiration lengths. We were doing a lot kind of in the 45 days to expiration, for instance, but I was
Mm-hmm.
exploring shorter, 3 days, 2 days, 1 days. And as you mentioned, Karsten was doing 1 day options, 2 day options. And I had a friend that actually he introduced me to early retirement now, the blog, because he says, hey, I know you're, he didn't, at the time I wasn't kind of into the fire aspect, but he was like, check out this blog. For one, you may like the ideas, but for
Mm-hmm.
two, he is doing these option strategies that are very similar to what you are now researching.
Yeah.
And so I think at the time, right now, Earn on his blog has it's like 13 or 14 articles in that kind of series of options related
Yes.
articles. At the time, I think there was 5 or 6, but I read those and it was really great because it opened my eyes to a different way of not the trading per se, but the risk management and
Mm-hmm.
the bankroll management. There is a term I coined called premium capture rate,
Yes.
which is just kind of like a way of saying how much expectancy you have. Because when you sell options, you collect the credit, but you need to keep the credit, right? So like that's
Right.
kind of your profitability margin. And so it was directly inspired. He didn't use PCR premium capture, but one of his articles, he talked about the idea of budgeting for, okay, yes, you're gonna have years where you do great, where years not so great, but on average, he was budgeting to collect about 40 cents on the dollar or something like that. And
Yeah.
that was the spark that inspired a lot of the concepts and the philosophies behind how we develop our strategies. So he's always been an inspiration. I had reached out to him and told him about it. We had some conversations. A couple of years later, he was on my podcast. And then so whenever he makes an appearance, I always listen. I really enjoy his talk on yours. And I know that like it's I really liked appreciate the opportunity to come on today because I know from looking at the comments on his blog, like you said, and the comments on your episode, which was even not that long ago, but
Right.
there's a lot of interest in the fire community for options because it is a kind of non-traditional avenue to
Yeah.
I don't want to say generate yield, yes, but it's kind of a buzzword now. So I
It
want to
is.
really drive in that there is risk. You have to know what you're doing. It's not a free lunch. And so people might have heard about these like zero DT ETF. There's a bunch of options related stuff in the media right now. So just like
Yes.
slow down. Like you have to really vet everything and like I'm sure we'll talk about some of the pitfalls and stuff. But
Yeah,
yeah,
for
that
sure.
was how I kind of that's how all that's related and how I'm kind of involved with Karsten and everything.
Okay. Regular viewers of Two Sides of Fine know that my own journey started pretty traditionally. I didn't do a whole lot of YOLO call, lotto buying myself, but I did do a fair amount of put selling for quite a while. Cheap way to get into stocks you want anyway, and there's premium to be made there. And then after doing that and some more tried and true strategies, some basic spreads, eventually found my way to finally taking the time to understand what Karsten was doing. And this is sort of, fast forwarding up to 2024 now after about 4 or 5 years, and was doing, 0 and 1 DTE put selling. And some call selling, just as he and I spoke about on the show. And the one thing I realized is that that episode provoked a ton of interest. And so, I started to think about, what how can we introduce these concepts to people better? We're not a show about options. There are people like yourself and many others who do a good to great job explaining and digging into all these topics. But it was quite clear that there's ample opportunity to at least point people in good directions. And the conversation between you and I on the Discord evolved from the perspective of there's an opportunity to follow up on some of the stuff we talked about. And so I know there are a lot of misconceptions and misinformations about the opportunity that option trading provides. And so I'm wondering if you can speak to, just kind of in brief, any of those misconceptions that you come across, and how your approach, maybe at a very high level, kind of works differently in that environment. Because a lot of what you say on Trade Busters, I think, really speaks to me about sensible mechanical approaches, rules-based approaches for trading options, which I know Ern is also a fan of.
So for starters, I think we should remind everyone, if they have not listened to your previous episode with Karsten, go listen to that first, and or listen to my episode with him. We can link, I forget the episode number, but we can link in the show notes.
I've got it.
But one thing, first people ask, if this, it's not that he's oversimplifying it, but to some extent, put selling is very simple. But people always ask, like, is it really that good? Why should you make money? Right now,
Right.
in that episode, he talked about all the economics incentives, the analogy to insurance selling. So we don't need to get into all that. But there's a question of, like, how much can you do? What is the proper expectations? And why can you not kind of ratchet it up necessarily? Because it's very easy to fall in this trap of, okay, this thing works, so I'll do it more. Oh, if I can make 1%, because Karsten talks about, it depends on your use case. If you want to add 1% to your bottom line to whatever else you're doing, he's right. Mathematically, that will really increase your odds of success, from a Monte Carlo situation, and all of those things. But, like, what if you decide, oh, if I can do 1%, so easy. Why don't I do 5%, 10%, 20%? Like, so there has to be a line there, right? So I wanted to take this opportunity to kind of level set and maybe show people why the expectations need to be grounded, at least in the way that Karsten does it. So I set up a very simple mathematical example. So hopefully, people need to pause and write it down, whatever, but hopefully it's pretty simple. So with Karsten's put selling, for instance, now let's say we have a strategy. I'm going to use simple numbers. 90% win rate. People always love this strategy because of the high win rate. Okay,
Yes,
so 90% win. So let's say odds are 90% you win $1. Let's just use round numbers. And when you lose, the 10% of the time, you lose 8. Now, expectancy is simply taking your win rate multiplied by your win amount, loss rate multiplied by the loss amount, add it up, and you get some number at the end. So if you do that, your expectancy on this odds, 90% of winning $1, 10% losing 8, is exactly 10 cents on the dollar. So on average, because if you win 9 times, lose 1 is 8, you're back to 1 out of 10 trades. So your expectancy is very simple. It's 10 cents. You will on average, make 10 cents per dollar. Very simple.
Right.
Now, if you take this example, it's great, right? And this is kind of like the casino example. You should just play those odds. Now, you can say, oh, because people talk about you can't scale this, but what exactly does that mean, right? So if I bet $1, if I win $1, lose 8, I make 10 cents per dollar. Well, let's ratchet up. If I do $100, either win 100 or lose 800, it's gonna just be 10 times that, right? It's average is gonna be $1 per trade or $100 per trade or whatever it is.
Mm-hmm.
But the thing is, like, okay, well, if I say, why don't you bet $1,000, $10,000, $1,000,000, you can start to realize something's not right, because, like, for one, I don't have $1,000,000, right? So there's limitations on the bet size. But beyond that, what's going to happen is, when we talk about these odds, right, this 10 cents per dollar, 20 cents per dollar, this is arithmetic expectancy. There's no compounding. We're just talking about dollars and cents. We're not talking about percentages. The issue is when you start talking about percentages, things change.
Yes.
Now, you've probably heard there's these graphics where, like, if you lose 50%, 50% drawdown, you have to gain 100% to get back to even, right? So from 10 to 5 is 50%, but from 5 to 10 is 100%. So this demonstrates what's called volatility tax. It just means compounding is asymmetric, and you compound more on the downside than the upside. So this 50% drawdown, 100% rise, that's a very contrived example, but that volatility tax happens even at small amounts. It's just less noticeable. So what that means is with something like the put selling that Karsten does, I think he was saying, I don't know where it's not, one delta, 1.5, he's selling like 50 cents, 40 cents. Again, go back to the episodes to reference it. But if you don't have a stop loss, you can easily have multiples of loss that are even greater, right? I did like an 8-to-1 example just now. And let's just say if you did 20-to-1. So I set this thing up where same example where if you have a 20-to-1, let's say you either win 1 or lose 20. Take a guess. What win rate do you need just to break even? If you're stumped, you can say pass, but you want to take a guess at what it requires. You
I always
win
have a
1 or
rule to
lose
not do
20.
math on the show.
Well, at a 95% win rate, you're still losing money. You're averaging 5 cents loss per trade on average.
Right.
At 96%, it starts to be positive. And so it's a very fine line. And the issue is when you're dealing with compounding, it gets worse. And I harp about this a lot on my podcast, and this idea that volatility will basically steal your edge. So if you have a winning trade system and you keep all things constant, but simply by virtue of sizing on a compounding basis above a certain amount, depending on the particular strategy, you can take a winning system and make it into a losing one.
Right.
The only thing you change is sizing. And so that's the thing I want to drive home is just the idea that like too much of a good thing can be a bad thing.
Yes.
So I want that to ground people's, yes, you can make consistent quote unquote income or gains from selling options within reason. But if you're not going to use very aggressive risk management, it's going to put a very quick cap on sort of the safe level that you can execute this type of strategy in this way without ultimately doing more harm than good. So that's kind of the thing I wanted to really get across.
I'm glad you make that point. I have to be completely honest with you. In my trading of earns put strategy, and you even hear me talk about this in some detail on the show. I don't disclose all of my approach. I thought I had put ample risk management in place, and the way I was assessing volatility and making my decisions a little different than his. He certainly doesn't disclose all of his secret sauce. The thing that pointed me towards TradesBusters, quite honestly, I can't remember if I've told you this before, was a couple of viewers of Two Sides of Fi who had seen that episode and who were active members of TradesBusters responded independently to me and said kind of, hey, love this episode, but based on what your goals are, I don't think that scaling this up is really what you want to do. There are more sensible approaches for your goals that we would suggest you consider, right? This is not financial advice, but here's some things that you might want to look into. And that was the opening of Pandora's box that got me deep diving to the point where my wife is saying, you're still at your computer. What are you doing? And it was just a really good kind of tipping point into there's another way to do this. There are different ways to think about it. And I'm not a gambler by definition. I'm a traditional buy and hold investor like most of our audience is, but I've always had this idea that, taking a percentage of that portfolio and being more adventurous with it is a very reasonable thing to do. And many people talk about this 5% or 10%, whatever kind of how you're wired. And so that got me started on looking more into mechanical trading, thinking very seriously about hedging and other risk management strategies. And that's gotten me to where I am today. So in the interest of potentially saving some of our audience members some time, if people do want to know more about those ideas, because many of them tell me they just don't know where to start. how would you direct them to continue their own education?
I would say learn the basics of options first. There's a lot of free content out there, but unfortunately, a lot of bad content.
Yes.
Option Alpha has a free course that has literally like a beginning, intermediate, advanced track, where it's just free courses to kind of brush up on the basics. Um, but beyond that, like, you can check out my podcast. Uh, I would say Tasty Trade as well. The only thing with them is it's a bit of a fire hose, and you
Yes.
might need to talk to somebody that is familiar and can kind of point you in the right direction of like which videos to watch. But I think once you have the basics, my podcast, for instance, it's a bit of I should probably organize the episodes a bit, because when I did the episodes in real time, it was always like whatever came to mind. But I do have episodes on like, hey, here is some foundational principles. Now, here is a strategy to apply them to. There's a couple strategies that are taught in depth. And then beyond that, there's like portfolio construction, talking about blending strategies and all that. So it kind of it's almost like its own course. Unfortunately, it's not laid out in that order necessarily. Um, but yeah, I would say those are a couple of resources
Okay.
that just to get started, maybe find a community like ours, or you could try. I hesitate to say that there's a couple Tasty Trade Facebook groups, but they're just really large.
Yeah.
But if you pay attention and read between the lines, and you have the time to kind of parse out and like be grounded and take things with a grain of salt. I mean, I got a lot of value out of those types of communities as well. Yes, I've left them for various reasons, but that was years later.
One of the thoughts that I've seen come up in the comments on our show is this idea of, we've got people in various parts, they're at various points in their journey to financial independence. We have people who are on the path, they're still working, they're still trying to generate savings and investment. We have people who are retired already, no longer working for pay, and their investments are to carry them through the rest of their life. All of those groups are interested at times in different investments. And so, what I'm wondering is, at a high level, how do you think about the role of options in a portfolio for people at different parts of their journey? Is it just another asset class? Is it, how would people think about it, and where does it fit, broadly speaking?
The idea is that systematic strategies for us are an asset, and we evaluate them just like we evaluate, like, if you're going to study, there's that portfolio visualizer where you can blend different assets, different ETFs, and you look at their ups and downs, and, oh, I do 10% of this, 20% of that. What does that look like? We do the same thing with strategies. So options is just another, like you said, asset class or strategies that we can add. And one thing that really stood out, and I want to break the mold a little bit, you mentioned earlier the idea of, oh, take a portion of my portfolio and put it into options, right? For us, it's totally different, because this concept of options, the way it works is, you hear the word margin. I know it's scary, leverage, but when you talk
Right.
about options margin, you're not borrowing. You're not borrowing to, like, 500,000. I'm borrowing to buy 200,000 of SPY, for instance. I'm leveraging my account. Options are leverage, but it's different. It's more about collateral. Um,
Yes.
and I see somebody in your Discord asked the other day, and I had this analogy. And basically, let's say I own my home in cash, right? I own S&P, or I own something in cash. That's my asset, and it's going to appreciate. So I don't want to touch that. Now, let's say my job as a profession was a gambler, right? I gamble. That's how I make money. Okay. If I go to the casino, normally you need to you have to give them cash and get the chips, and play your game, whatever. And at the end of the day, you take home the profits, right? But if I had to borrow money from my house to go get the chips to play, in this case, I've borrowed money, I've incurred a funding rate, there's an interest cost, and that's kind of like a hurdle I have to overcome just to break even, right?
Right.
But it doesn't work that way. With options in your brokerage account, if you have a kind of margin account, it's almost like the broker or the casino, they say, hey, you have this asset, you own this home, you own these stocks. Stocks are, quote unquote, marginable. Instead of needing to give us cash for the chips, we will just give you the chips. We'll front the chips to you, because we know that you have a collateral there. If you lose money or we need to be made whole, we will take it from your house or whatever it is. We'll foreclose, or you'll borrow the money from house, so on and so forth. So you can go and get the chips and go, do your business, hopefully be profitable
Right.
without incurring an additional funding rate or interest
Exactly.
cost. And then, so with options, you can basically trade these strategies as an overlay on top of whatever your account has, your traditional portfolio, your stocks, bonds, whatever it is. And different types of assets are kind of marginal different rates. Like if you own
Yes.
100,000 Tesla stock, they might not give you 100,000 chips. They might give you
Exactly.
50,000. But if you owned something like T-bills, which is like a cash equivalent, if I have 100,000 T-bills, they may front you 99,000 in chips because you basically have cash. And so this idea of margining against your assets to trade an additional strategy, I don't want to get the wrong idea for it, but this is truly a free lunch in the sense of the capital
Yes.
is free to utilize, right? Not free lunch as in it's easy money, but this is truly, you basically can get two portfolios for the price of one, right? So you can overlay and stack the options return on top of whatever else you're normally already doing without having to interrupt that to a
Yes.
degree, right? Again, if you own something super volatile and your stocks go to zero, you're not gonna have any margin and your options are gonna get closed out. But
Precisely.
that's the idea of how I kind of think about. And so obviously, depending on where you are in your financial situation, your risk tolerance, you don't have to go so aggressive. And that's why Karsten says stacking even a 1% return on top of your whatever you have,
Yes.
it can be very meaningful on a compounding basis.
What I did is I took 10% of my overall portfolio, which is in this case, I took primarily money market and T bills and moved them into a different brokerage where I then use that as collateral. So, margin meaning collateral, just as you explained it, to trade a variety of strategies. And you know, it's not saying that I am putting all of that up and could potentially lose all of it because, of course, I had to explain this to my wife when we started down this journey. Is I'm presently trading somewhere around 15% of possible buying power of that 10%. And
Right.
while all models are at least partially incorrect from a backtesting standpoint, the max drawdown on this strategy over a number of years is, let's call it 5%. So when you actually do all that math, I'm not being, especially because of the risk management that's in place, this is not, trying to put it all on one number in roulette. This is just trying to generate some additional income effectively and learning a lot all the while and being very interested from a technical perspective at all of the math that's involved in these strategies. And so for me, that's how I think about it. It's actually very enjoyable because I'm not doing this as a primary source of income, nor trying to drive myself to kind of double my income or something like that. Where for me and my personal risk tolerance is not at that place of my life. So I think that sizing concept that you've mentioned several different ways here is vital to consider. And one of the things that scares me the most when I look at some of the YouTube content and other social media, TikTok in particular, that this is kind of swept under the rug, and that's obviously a huge miss.
Yeah, no, it's kind of unfortunate, and I think a lot of the way the education landscape is shaped is just kind of the flavor of the month or what's the latest hot trade or the hot trend. And unfortunately, like uh, it's funny. There's all these what I call them the wheel accounts on Twitter.
Oh
People who are just
yes.
oh I'm trading the wheel and like I jokingly say that's kind of my signal for like the top of the market. Like whenever that crescendos and like everybody's saying oh yeah, literally there's some guy posting his post literally says you know it's so easy to make money just push some buttons. I wish everyone could do this. It's like well you know how that's gonna end eventually. So
Yeah.
yeah, it's unfortunate, but I'm the podcast I do is kind of my own little part to try and to fight that a little bit, I guess.
Yeah, no, I think it's great. And I do like that your podcast, Trade Busters, yes, there's technical trade content. You've, spoken over many episodes about your Trinity system, for example, but there's more content actually on trading philosophy, mindset, why, the edge of mechanical trading. You've talked to a number of other investors or people in the options community about their worldview on these topics. And I honestly think people who are truly interested in options will benefit much more from that type of content, as well as just this, the purely mechanical things that I think our brains are drawn to, right? How can I do this? Well, there's a lot more about how, there's a lot more involved about how you think about and how you execute these things and how you think about risk and manage risk than, oh, mechanically it's this delta and this DTE and that's how I make money.
Yeah, and there's one other thing that I think may resonate with your audience specifically, because you want to reach. Karsten says, when you reach financial independence, right? It's not just about quitting your job and I'm done, right? I'm doing nothing. But at the same time, like it frees you to pursue your hobbies, right? So you can pursue this interest. But at the same time, you don't want to just make another job out of it, right? You don't want to do something
Exactly.
where you have to spend and be stressed out. And so there's a concept like there's a couple of things. One, I have this, people talk about return on capital. I talk
Yes.
about return on time. How little can you spend actually executing and generating some return, right? So you want to minimize the time spent, right?
Yes.
And the other thing is, I had this phrase called passively active investing, right? So it's like it's active because you're doing something. But again, I try to think of it as a passive thing, this idea of strategies as assets. So like I set this thing in motion, right? So I have my slice of S&P, I have my slice of bonds, slice of whatever it is. Here's my slice of options. And it's just something you set in motion. And I'm a passive investor in this active strategy. That's kind of
Yeah.
the phrase I use. On purpose, I designed what's called low touch strategies, right? These were
Yes.
one entry, one execution. You set some kind of profit take or stop loss, and it's designed to be light touch.
Yes.
And there's definitely baby steps you can take. And I wanted to basically, through the progression of podcast, like the foundational concepts, but then introduce simple strategies that you can ease into and execute on a small scale just to get the repetitions. And then, if you decide you want to go all in and do the automation, all that, that's definitely possible. But
Yeah.
there's a transition there for sure.
David, we've covered a lot of ground. I just want to pause and ask, is there anything that you'd like to kind of leave the audience with in conclusion?
Yeah, I was just gonna say, like, I presume your audience is kind of open-minded to begin with, like to be on pursuing this kind of non-traditional path. So options are just a tool. um, it's important to kind of ground the expectation, right? They're not some magic silver bullet, right? But as we discussed earlier, if you think about it as an asset class, there are simple strategies where you can meaningfully add value to your portfolio without having to create another job or be super stressed out. But you just have to really ground the expectations, right? So on the one hand, again, on the extreme, if your use cases, I want to add 1%, right? I do believe that's very reasonable. You
Yes.
can add 1% with relatively low risk. But as soon as you start talking about 5, 6, 10, 15, God forbid 20 or 30, like it's doable, but that's the kind of a whole different level. Like, and if you want to pursue that path and get the education, I think it's doable, but just know that it's very different and they require kind of a different skill set. And it's like risk management becomes extremely paramount as soon as you get beyond kind of a diminutive size because of that idea of the asymmetric compounding and the volatility tax that we discussed earlier.
Yes. I think that's a great summary. It's a wonderful place to leave it, David. I want to thank you for your time, but I want to also give you the opportunity. If people want to find out more about you, about Trade Busters, how can they get in contact with you?
Yeah, so I am on Twitter/X. My handle is at the Trade Buster. DMs are open. Feel free to message. You can look up the podcast. It's called The Trade Busters. S with the plural, like the Ghostbusters, but the Trade Busters. That's on most major platforms, Apple Podcasts, Google Podcasts, and the actual trading page I mentioned, which is don't be surprised. It's www.thetradebusters.com, but it's not an actual website. When you click there, you go to like a Google Sheets.
Yes.
It's kind of like a running joke now, like, oh, will I ever make an actual website? But I found it's very flexible. I'm used to doing spreadsheets, so I'm used to just hosting everything there. My contact email is on there. So if you want to reach out, and actually you need to email me if you're interested in joining the Discord community. And I encourage everyone to get educated, learn about this, asset class, quote unquote, and just to open your eyes to a different way of doing things. And I will mention that, if you guys decide that it's something, you're interested in having this kind of exposure, we're open to investors if you want to reach out as well. For regulation reasons, I can't really talk about much about the funds or the return, all that stuff, but just if it's something you're interested in, and I figure if you're open-minded, I definitely encourage you to learn and try it out first. But at the same time, if you understand and you like these kind of strategies and these kind of, think he's a good fit, happy to talk and reach out. But yeah, there you have it.
Great. David, thanks so much for your time. Everyone, be safe out there and be careful with your options. Take care.
Great. Thank you, Jason.